Welcome back. Well, China has been struggling to regain its ground post the COVID-19 pandemic, with the stock market shedding 40% of its value over the past 3 years. Despite the downturn, some investors aren't writing the region off, saying there's still value in that market. And joining me now as we take a look at the pockets of opportunity in China is Simon Fillmore, Chief Investment Officer at Independent Securities. Thank you so much for your time, Simon. Now, when we look at this shift to Chinese equities, is the big thing here valuations, that they're just too cheap to pass up?
Yeah, I think certainly one of the aspects one needs to look at is the valuations. And if we just look at a pure index level, the Hang Seng index is at the same place it was 27 years ago. On that basis alone, it looks like it's offering great value. And then when we drill down further into the underlying companies, we find some of the cheapest investment opportunities we've certainly seen over the span of our investment careers, which is typically what you would expect at the bottom of a market. And so just to talk about some of those opportunities that we see, and some of the valuations that we see, if we look at a business like JD.com, which is one of the third largest online retailers in China, it has its net cash balances represent 80% of its market cap, which you just don't generally see. It's literally unheard of. Similarly, with a company like Alibaba, a third of their market cap is represented by net cash, which is also, once again, very cheap. And then if we look at just the pure old PE ratio, which is a shorthand, but it does give some indication of the valuation, both of those companies are trading at very low single-digit PE multiples.
Does that translate to a significant earnings momentum? Because, for example, when you look at the US, it's still quite clear that earnings are growing in line with economic growth that is still strong in the US. There has been concern over the macroeconomic environment in China, and particularly the momentum, or rather the pace of growth that we have seen with economic growth, though. Can we, expect, any boost in earnings while, I guess, the economy still maybe has this kind of choppy narrative around it?
Yes, I think you're quite right. The growth in China, certainly amongst corporate growth, specifically in the IT sector, has certainly slowed. And that's one of the reasons why these shares trade at the valuations that they do. They obviously had a massive regulatory crackdown a couple of years ago, and that impeded their ability to grow. And that's one of the reasons why we've seen the devaluation of these shares. But I think that's one of the reasons that we're getting excited about them now, is that there's an opportunity for that economy to change and move from manufacturing, industrial, infrastructure-led into consumption-led growth. And we feel that there's that consumption-led growth, which would be a trigger and a catalyst for broader economic growth. And basically, what we have seen is investors have been expecting big bang stimulus from the CCP, much like we got in 2010 and 2016. But so far, they've been disappointed. And we don't think there'll actually be a similar type of stimulus. But what we are seeing are more subtle signs. And increasingly, the CCP is trying to encourage investors to invest in the stock market. And the reason why they're trying to do that is just because when the stock market goes up, people feel confident, they start spending money, which raises employment, is good for productivity, leads to high GDP growth. So that's what ultimately they're trying to achieve. And the measures that we've seen the CCP implement are they've halved transfer duty on purchases. They've encouraged institutional investors to participate more in the market. In terms of insurance companies, their capital adequacy requirements have been changed more in favor of equities. So it's a balance of those where we see the government just increasingly ask institutions to invest more in the market. And we think as that goes, as the market turns and starts increasing and people's wealth increases, that'll just set off a positive feedback loop and set off this virtuous cycle.
Yeah, and it's really quite interesting, you know, this shift that you make of the Chinese economy being manufacturing and infrastructure led now to being more consumer led. And of course, we know that tech plays a very significant role in there. Of course, as the market, we love comparisons between the US and China. And of course, we know, you know, the big boost that the US tech companies have had because of that AI boom. But of course, a lot of people, as much as there's this narrative that maybe there should be a rotation from US tech to Chinese tech, people's bread is still being buttered there in the US. Do you think at this point, you know, people should maybe just, you know, take their profits out of US tech and into Chinese tech, or is it not a thing of either or, that you can have exposure to both?
Yeah, I think you can have exposure to both, and yeah, so long as the growth rates from Chinese tech remains fairly robust, like we're seeing now in the current reporting season, I think there's no reason to really cut exposure there. But I think, our viewpoint is more if you're a South African investor and you've endured a long period of underperforming global stock markets, it makes sense just to hold on to your exposure, because inherently you have fairly significant exposure to China via Naspers and process via all the commodity companies, and of course Richmond. So while a lot of people may be looking for the next which area of the market or which region or sector is going to be the next best performing part of the market, we think China might be already in it, and most investors in South Africa already have significant exposure to that region.
All right. Well, thank you so much for your analysis and for your insights today on that, Simon. Really appreciate it. That was Simon Fillmore from Independent Securities.